Welcome to the Osborne Financial Group podcast, hosted by Jared Osborne. Join us for expert insights on wealth management strategies, essential tips for securing your financial future, and in-depth discussions on life and health insurance options. Get practical advice for protecting your assets and loved ones, proven strategies for maximizing investments, and real-life examples to illustrate key concepts. Stay tuned for Q&A sessions with industry professionals and actionable steps to take control of your finances and insurance needs. Tune in now and empower your financial journey.
Well, hello, everyone, and welcome back. You know, there are many products that exist within the insurance space that serve a dual function. They act to insure and also as investment vehicles. And we've talked about many of those on the show before. One of those tools is the subject of our conversation today. We're going to talk a little bit about health savings accounts, or HSAs. Jared, why don't you start off by telling our audience a little bit about what health savings accounts are and kind of how they work?
Okay. So good morning, everybody. Thanks for joining in. So what is a HSA, or health savings account? A lot of people probably have heard of them. What they are is they're accounts. They're essentially investment accounts, or not necessarily investment, or accounts set up that have to be aligned with what are called HSA qualified plans. Some people call them high deductible health plans, HDHPs. If you have an option, if you work for a company, a lot of times they're offered in conjunction with a conventional plan. Basically what they are, and they're very powerful, especially from a tax basis, but there are some caveats to these plans. The plan, like I said, the plan, in order to set up a health savings account, you have to have what's called an HSA qualified plan. These plans, typically, they call them high deductible health plans, but in today's world, some of them aren't necessarily that high of a deductible. So, for example, if offered, an HSA qualified plan at work, you can enroll in that plan. Once you enroll in that plan, you can set up, if you want, a health savings account. It could be done, through the administrator that the underlying health carrier, like United Healthcare or Aetna, has their own health, administrators that you can put money into on a tax-free basis. So the money you put into these health savings accounts, if you have an HSA qualified plan, are tax-free. Okay, the money you put in, you do not pay taxes on. Okay, not only do you not pay taxes going in, if the underlying administrator or the HSA the HSA allows you to invest the money, some do, some don't. The growth in those, if the potential growth, or hopefully you have some growth over time, if the market does well, you can invest in the markets, mutual funds like a 401k or an IRA. You have a choice of sub accounts or mutual funds. You put the money that you invest, into the HSA. You can allocate it to these different funds that the administrator offers, and if you pull it out for qualified medical expenses, the growth and the money that you take out is tax-free. There aren't many things in this world that you can get tax-free going in, tax-deferred growth, and if used for qualified medical expense, you can pull that money out tax-free. Now, there are contribution limits. If you're an individual, for 2025, you can put $4,300 in. If you're a family, you can put $8,550 in. That typically goes up a little bit every single year. Okay, so that's the now there are many rules to these, what you can pull the money out for. So, for example, qualified medical expenses, obviously anything that is, co-payments, co-insurance, deductibles, dental, vision. Can you go to Home Depot and buy paint? No, you're not allowed to do that. I mean, you can certainly, try, but you can get penalized for that.
So, hey, Jared, hold up for a second. I've got a question that's going on in my mind. So if I understand correctly, these HSAs are primarily, the function is kind of to work as a supplement to regular insurance policy, or are there scenarios where people just have an HSA? It sounds to me like it's best to have some primary insurance, and then the HSA is kind of like a backstop to that. Am I reading that correctly?
So you can't just go to your bank or wherever. I mean, some banks have health savings accounts, some don't. Fidelity, Optum, which is United Healthcare, Vanguard, they all offer these accounts. In order to open an account and fund it or contribute to it, you have to have an underlying health savings account qualified medical plan. So it works in conjunction. Now,
Got it.
if you just I want to open an HSA, no, it has to be, it works in conjunction with that plan. You can't just have a regular standard, regular plan. That's not. And when you look at your options, if you work for a company, I was just looking at a friend. He wanted me to take a look at he just started with a new company. They had a high deductible health plan or an HSA qualified plan. They had two other PPO plans that were not HSA qualified. So if you wanted to go with those other plans, which he did, one of the other plans, he can't open an HSA or a health savings account, okay, and fund it. In order to fund them and open an HSA, you have to have a specific type of account. Now, these accounts, these underlying plans that work in conjunction with the HSA work a little differently. And that's the kind of caveat to that. When they say high deductible health plans, believe it or not, you can have a health plan with a 16, I think the minimal deductible on one of these plans is $1,650 for an individual or $3,300 for a family. And the max deductible is $8,300 or $16,600 for a family, $8,300 individual. So if you, believe it or not, in today's world, if you don't know much about health, do you think, $1,650 is a high deductible? It's not. It's probably a really low deductible in today's world. I mean, silver plans on, you look at have $3,000 or $4,000 deductibles. That's an average deductible in today's world. So one, high deductible health plan is not necessarily all the case. You may have a high deductible health plan that has a $1,650 deductible, which is a great and a very low deductible in today's world. Secondly, on these plans, because you're getting these tax benefits, everything except for your preventative, which is covered at 100%, that's mandated part of ACA or Obamacare, everything is subject to the deductible, even prescription drugs. So you don't get, it's not going to be, hey, I'm going to the doctor and it's just going to be a copay. Even your doctor visits, not including preventative services, wellness visits, your annuals. Everything is even prescription. So you go to the doctor, a specialist, you don't feel well. Or you have a hurt knee, you go to the orthopedic surgeon. It's not just a specialist copay. It's typically a copay and subject to the deductible. Now you're going to get that negotiated rate just by having the insurance, that contractual rate that you get between the insurance company and the provider or facility. But it's going to cost you a little bit more. Now, you can use your HSA funds for that visit or those visits. You get a debit card when you open an HSA. When you open it, so you actually have a debit card. The money you put in, you use it, you go in, you pay for it. Great, it comes out of that account. Okay. These plans also are typically a little less expensive than the PPO or the HMO that they're offering because everything is subject to deductible on these plans. So you got to be careful and understand. Some people say, well, why wouldn't I just do that all the time? Two reasons. One, let's just say, you have a deductible of $8,300 on an HSA qualified plan, and you take expensive medications. Okay, you're a diabetic. Okay, yes, you can contribute to the HSA. You can put in the $8,550 max if you want. You don't have to. You can put in less. You can't put in more. You don't have to fund it. It doesn't make sense to really have a plan to not fund the HSA. But if you put in the $8,550, you have that full amount to use for medical expenses. But remember, if you have a really high deductible plan, HSA qualified plan, let's just say it's $8,300, the max, for an individual. You take diabetic medications. Everything is going to be subject to that $8,300 deductible. Diabetic medication is typically very expensive, or you have cancer, or you have a high, a specialty drug that's very expensive. So you kind of have to say, okay, are the tax benefits, let's just say you're 20, 30, say you're a 30% tax bracket, you're a high earner, and you fully funded $8,550 times that 30%, you're getting almost close to $3,000 tax break, because you're not paying taxes on that 8550 you're putting in if you put it in. And you're in a 30% tax bracket, do the math. It's almost a $3,000 tax savings. Conversely, if you are one of these people that have, high cost prescriptions, or you're having a procedure that you know about through the year, or you have a procedure that you don't know about, it just came up, and you have a high deductible like $8,300, probably not going to make sense to get that HSA qualified plan. Probably not, because the tax benefit outweighs the overall out of pocket expense that you're going to incur with your drugs or a procedure that you're planning on, like a knee surgery or something.
This stuff, that's why it's so important. I say this all the time, to have somebody like yourself involved with these types of decisions, because there's so many. Health insurance on its own is already confusing enough, but when you pair it with the component of tax and tax shields and investments, it becomes even more complicated. But I want to make sure I understand this properly. So go down the rabbit hole with me on my logic and tell me if it's flawed.
It's confusing.
So if I understand correctly, this would make, like, having an HSA wouldn't necessarily make too much sense, other than the fact that it's a tax shield, for somebody that has a plan in place that is a high premium, low deductible, the type of plan that's not going to be a lot of out-of-pocket expenses, and then for somebody that does have higher deductibles and things like that, it would make sense to supplement it with an HSA, so you have money saved up to pay those large out-of-pocket fees when they come. Am I getting that right at all? Or, like, when would you typically recommend this for a client?
So it could work for both ways. If you have a low, if you have one of these HSA qualified plans that happens to have a fairly low deductible, take like a $1,600 or $2,000 deductible, okay, it's still a great vehicle to. It's always, in my opinion, especially if you're in a high tax bracket and you're fairly healthy and you have some prescriptions, but you're not taking really expensive specialty drugs, to fund an HSA as a matter of fact, I have an HSA. Okay. I put in my $8,550. I've had an HSA qualified plan for many years. I put in $8,550. I barely use it. As a matter of fact, I tell my wife, when you go to the doctor, or you take the kids to the doctor, and you have to pay a premium or even a high copay, and it's subject to or deduct something that's subject to the deductible, even if it's $200, $300, $400. I tell her, don't use the HSA.
So don't use the thing
that's
that it was intended for.
There's books written on this. This is the way I'll put my financial advisor hat on. The reason is, and look, some people can't afford that. Okay. If you can, there's actually books written on this. Okay. The benefit of you kind of, and another thing, Jeremy, the money you put in an HSA is always yours. Always. You can roll it over every year. It continues even if you don't have an HSA qualified plan. You can't contribute to an HSA, but you can always have that money in that account and use it for qualified medical expenses, even if you're not funding it or have an HSA qualified plan. That money is always yours. So, for example, in my situation, I've had an HSA for 3 or 4 years. I fully fund it. I have almost $25,000 or $30,000 in my account. My thinking is, and I'm able to invest it with my administrator, which is Optum. Okay. I put it into mutual funds. I put in, and I do it. I put in every month a certain amount. So by the end of the year, I fully fund it. It's not a hard math. It's divide by the number of weeks, that's 8550, because I have a family, divide by, if you're do it at the beginning of the year, divided by, 52 weeks. That's what you put on a weekly basis. You can do it monthly. You can put in a lump sum anytime throughout the year if you want. Okay. The thing with them is, I believe, if possible, if you can do this, don't use it until you get a little older. Let the money accrue in this account for many, many years. My thought is, I want to do this for 5, 10 years, 5, 6, 7, 8 years, have 50, 60, 70, $80,000 in there. When I turn 65, which is down the road, but when I turn 65, okay, and I go on Medicare, I can't open an HSA qualified. I can't have an HSA qualified Medicare plan. I can't fund it any longer, but I can use it for long-term care premiums. I can use it for health expenses that I'm probably going to have more of when I'm 65 than now. I'm very healthy, thank God, knock on wood, and so is my family. But my daughter had knee surgery. It cost me a couple $1,000. I could have taken it out of the HSA. I decided not to because I want that money to keep accruing. So I paid it. I got the negotiated rate. It came off my deductible. or my daughter's deductible, and that's that. Now, certainly the money I could have taken that, debit card and used it, and, it came right out of that account. Great. You can do that as well. But there's actually the benefit of you kind of accruing these funds for 5, 6, 7, 8 years, if possible. Okay, if possible, if it's doable, to build up a nice pool of money for you to use as you get older when you're going to need it more is very valuable. Plus, you have all that growth. You can still pull the money out tax-free, even though you don't have an HSA qualified plan. You can't fund it. You can use these accounts. So the money's always yours, always.
So if I understand correctly, if you pull the money out for something that's qualified for health, like a health related transaction, whether it's long-term care, whether it's a deductible, that is tax-free. But if you want to access the money, which you can do after that for something unrelated, like let's say you wanted to buy a car, whatever it is, you could take the money out and then you just pay whatever the tax.
You got to pay a penalty and
pay a penalty as well. Okay, so there's a penalty in it.
Yes, it's a penalty, 10%, and your taxes, or is it 20? It's a penalty and taxes. So, yes, you can certainly pull it out but remember, because if it's a qualified medical expenses, tax-free. If it's not, taxes and penalty. Okay. Once you hit 65, okay, because you're not going to have a HSA qualified plan, if you pull it out for anything above and beyond medical expenses, then it's just taxes. Becomes like an IRA at that point because you've reached a certain age. Okay. Another thing is the money that you put in that I forgot to mention, the 8550 and the 4300, like an IRA, you get what's called a catch-up provision if you're 55 and older. An IRA is actually 50 and up. If you're 55 and older, they allow you to put an additional $1,000. So let's just say I'm not 55, but let's just say I have an HSA qualified plan. I can put in 9,550 for my family, or individual 5,300 if I was 55 or up. Okay, so they give you a catch-up provision as well. So just add another, confusion to the whole thing. But
man, this stuff just gets me. It is so confusing.
It's one of the most. I mean, from a tax standpoint, there's not many things. I mean, 529s are very similar, but that's after tax dollars. 529s accrue, the money grows tax deferred. If you pull it out for a college expense, qualified, it's tax free. Great vehicle. I'm a big proponent of 529s, but the money goes in post tax. HSA is pre-tax dollars. So I mean, think about the value. I mean, just to have an HSA, if possible, as long as you understand that the underlying major medical plan that it has to be attached to work a little different. Everything is subject to the deductible. So you will have more exposure, most likely, comparing a regular plan, conventional plan to an HSA plan. They'll be a little bit cheaper in premium because of that, everything's subject to deductible. You'll be able to fund the HSA. So you add up those two things. Okay, what are my savings and premiums? What are my real tax benefit? If I'm at 25 or 30% bracket, I'm going to fund it. And then what is my real exposure compared to the conventional plan that they're offering? And does it make sense for me? That's really, and yes, that's what I do. And, some people understand it. Most people don't. Most people don't know the rules. And so you really kind of have to evaluate it, like that. It's really, more of a dollars and cents thing. And it's not a hard calculation, but you got to understand, because a lot of it is based on estimates or unknowns or variables that you may not know, like, hey, I may not have a claim right now, or know, I'm going to have a knee surgery or something. And maybe I do know that, but most people don't. What is my total exposure? If my exposure to a conventional plan is $3,000 or $4,000 more than my worst case scenario on a HSA qualified plan, but I'm getting tax breaks. I'm saving, if I put fully funded, I'm saving $2,000 or $3,000 in taxes. Plus my premium saves me $1,000 or $1,500 a year. Let me compare that to my exposure on a fully funded regular plan that I can't, contribute to an HSA. And that's how you have to look at it.
Very, very interesting. For my money, for what it's worth for me, I mean, this is why it's so important, and talk about this all the time, having trusted professionals like yourself in these complex areas to give you advice. I mean, for me, I literally want to sit down when it comes to this type of stuff, and I want somebody to look at my situation and give me advice. Obviously, explain what it is, so I have a decent understanding. But I want to be able to trust in your plan and your advice, because there's so many different moving parts here. And one of the reasons why wealthy people tend to get wealthier and poor people tend to stay where they're at is because there are so many tools and vehicles available for those that have the resources. And when you could hire somebody like yourself and work together and mobilize those resources with these various tools, they're all different components of long-term wealth building. And I think it's just fascinating.
And like you said, that disparity, that variance between the haves and have-nots, that's a problem with these plans. Because when I talk to people, especially when I'm talking to a group, let's say I'm doing a group, and you have somebody who doesn't, in the budgetary, from a budget standpoint, that can't fund an HSA, but they want to. When you talk to somebody who's a little bit, you make, makes more, they can typically contribute. So those people who really can't contribute to the HSA, it really doesn't make sense to have one of these plans. Yeah, you'll save on the premium, but at the end of the day, every time you go to the doctor, it's going to be a copay and subject to the deductible, and could be $100, $150 at a specialist visit as opposed to a $50 copay. I'm making up that, but that's typically what it is, $60. So those people, an HSA plan probably wouldn't make sense. Okay, for those people who can afford it, it typically makes a lot of sense, especially if you're in a 25-30% tax bracket, that you can contribute to these plans. You're not on a high specialty drug, or you don't have a lot of health issues where you're going to come out of pocket. It typically makes sense for those people. And yes, there are a lot of moving parts to it. Another thing is and I know we're ending, we're running out of time, but these can be offered individually. So you can go to the healthcare, the exchanges if you're, on Obamacare or individual plans, or through a group. Okay. A lot of times, if it's offered through your group or through your company, okay, the employer will contribute to your HSA. So I was just explaining a plan to a friend of mine. I was taking a look, just mentioned it. They contribute $1,500 into the HSA. So that's a really good benefit. So they can contribute above and beyond that. The family, you can contribute an additional almost $7,000 if they're contributing $1,500. And you can do that on your own through payroll, or you can set up an HSA personally and just do that. So, it can be offered on a group or individual level, and the employer may or may not contribute. Another thing, Jeremy, is the max that I talked about, the $8,550 that you can contribute as a family, or $4,300 for an individual. You don't have to contribute the full amount. You can say, I can only contribute $5,000. Great. That's still good. Okay. Or I can only contribute on an individual of $2,000. Still great. Okay. But you don't have to, let's just say you start contributing for the year and, something comes up, you need a new roof on your house, or, you have a major financial issue and you can't contribute to it anymore. Okay. You stop. Okay. So you're not beholden to contribute to these plans, or you don't have to max out them, but the money's always yours, even if your employer contributes. And that differs from, and I won't get into, too much of it, FSA or flexible savings account, where you kind of you use it. You have to use it by the end of the year, or you lose it. So they differ. They're much better. HSAs is always your money. You can take it with you. You can have it forever.
All right. Well, let's leave it there, because we got to jump off. Everybody, thanks for tuning in. If you like this content, don't forget to like and subscribe and all that fun stuff. Leave us your comments. Leave us your feedback. We appreciate you all tuning in. And if you have any questions or you need help with any of this stuff, reach out to Jarrett anytime. His clearly a wealth of knowledge, and he's here to help in any way he can. Everyone, take care. Have a wonderful day, and we'll see you next time.
That's everybody. Take care. Have a great
Thanks for tuning in to the Osborne Financial Group podcast. For more financial tips and personal advice, visit us at www.osbornefinancial.com. That's www.osbornefinancial.com. Or give us a call at 954-963-3300. Take charge of your financial future today.